I've been investing and running businesses for decades, and if there's one thing I've learned, it's that most people have a very simple, and often wrong, understanding of financial risk. They tend to think risk is volatility, the ups and downs of the market. If stocks fall, if interest rates rise, if the headlines scream uncertainty, they panic. And if nothing seems to happen, they assume there's no risk at all. That's the misunderstanding. Risk isn't just the fear you feel when numbers move on a screen. Risk is the impact of your decisions over time. It's the combination of probability, timing, and consequence, not just a chart moving up and down. Understanding this difference is the key to thinking clearly about money. And unfortunately, many people spend their lives avoiding the wrong kind of risk while quietly exposing themselves to the kinds that matter. For decades, the advice was simple: diversify, hold cash as a safety net, avoid volatility, and you'll be fine. And in some ways, it worked. But the environment has changed. Interest rates fluctuate, inflation surprises us, and asset prices shift unpredictably. What was safe yesterday isn't always safe today. And the cost of misunderstanding this accumulates quietly, month after month, often unnoticed until it's too late to act efficiently. Here's what I tell people when they ask me about risk. First, there are two types of risk that matter: the risk of loss and the risk of opportunity cost. The risk of loss is obvious. You put money somewhere and it goes down. You feel it immediately. That's volatility. But the risk of opportunity cost, that's the one most people ignore. It's what you miss when you sit on the sidelines, waiting for the perfect moment that never comes. That's where real wealth erodes. You're not losing money in dollars, you're losing potential. And that can be far more damaging over decades than a temporary drop in a portfolio. I see this every day. Smart people, disciplined people, sometimes even experienced investors, misread these risks. They think staying in cash, waiting for stability, or avoiding stocks during a dip is cautious. In reality, they're missing the compounding benefits of assets that work while cash sits idle. They think safety is a state of mind, when safety is actually measured by the ability of your capital to grow, preserve value, and respond to opportunity. Understanding risk means asking the right questions. Instead of, "Will the market crash?" ask, "What will happen if I do nothing?" Instead of, "Is cash safe?" ask, "Is my money keeping up with inflation and opportunity costs?" Risk is contextual. It's not absolute. Timing matters less than positioning. Discipline matters more than luck. Let me give you a concrete example. A few years ago, I noticed a pattern among some clients and friends. They were hoarding cash, terrified of volatility. Headlines screamed uncertainty, yet the markets were quietly recovering, businesses were growing, and assets with pricing power were compounding. Month after month, their cash didn't lose on paper, but its real purchasing power was quietly diminishing. And the opportunities they ignored? That's the part most people never calculate. By the end of the year, they had less optionality, less flexibility, and a portfolio that underperformed what it could have achieved if they had recognized the real risk: inaction. That's the mistake I see most often. People treat volatility as risk and inactivity as safety. But in reality, the most significant risks are the ones that quietly erode your future options. That's why I always evaluate an asset or decision along three principles. First, does it preserve or increase purchasing power? If it doesn't do either, it's not serving your goals. Second, what are the opportunity costs of holding or avoiding it? Ignoring this can be more dangerous than a temporary market drop. And third, can I respond flexibly if circumstances change? Flexibility is often undervalued, yet it's the ultimate safety net. Let me be clear. I'm not saying volatility is meaningless. Losses matter. Downturns hurt. But treating volatility as the sole measure of risk is a trap. I see it every day with investors who sell in fear, then miss the rebound, or who stay in safe cash for too long and watch opportunities slip by. Real risk is multidimensional, and understanding it requires discipline, perspective, and willingness to engage with numbers and incentives, not headlines. I also want to highlight the human side. Behavioral biases amplify this misunderstanding. People are naturally loss-averse. We feel losses more intensely than gains. That's hardwired. It's why many investors retreat at the wrong time and stay too conservative when the world rewards action. Emotional reactions are not financial strategy. They're instinct. And instincts don't build wealth over decades. Understanding this allows you to step back and evaluate risk rationally. So, what should a disciplined investor do? First, recognize that risk is not just what moves on the ticker. It's what happens when you fail to act intelligently. Second, position capital in a way that it works, grows, and preserves purchasing power. Third, treat every financial decision as a combination of likelihood, consequence, and optionality. Finally, remember, safety is never absolute. It's a function of your strategy, not a feeling. I've learned to treat financial risk as a tool, not an enemy. Volatility is not the villain. Misunderstanding risk is. Misreading opportunity is far costlier than a temporary drop in stock price. And if you want to be successful over decades, you have to balance caution with intentional action. That's why I always advise, understand the mechanism, measure the consequences, and act with clarity. Fear is easy. Clarity is hard, but it pays far better over time. In the end, most people misunderstand financial risk because they focus on what's visible, the headlines, the charts, the noise, instead of the underlying mechanics. They see risk as a reaction, not a consequence. They confuse inaction with safety and volatility with danger. If you can shift your thinking, you'll position yourself ahead of the crowd. You'll respond rationally, act intentionally, and avoid the traps that catch the majority of investors. Risk is a tool. It's not your enemy. And understanding it properly is what separates thoughtful investors from reactive ones. That's what I do every day. That's what keeps my capital flexible, resilient, and growing over decades. And that's why most people get it wrong, and why understanding it correctly can make all the difference.